Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about Tesla's Q4 earnings report, primarily as it relates to the earnings storage that you see here on the screen and how that compares to another channel favorite via STEM Inc. So if you want to look at this presentation, this is available on their website under the Tesla Investor Relations, and I am primarily going to be focusing once again on the energy storage, and that is the only part of this that I'm going to be tying out to. The first thing that I'd call out is this is an area that is increasingly getting additional viewers, additional scrutiny, as it is something that a lot of people are turning to and saying there is going to be a lot of growth in this area. And as someone who is long STEM, I would agree with that assumption. The question is, how material could this be? How big of a player does Tesla have the capability to be? And ultimately, how is that going to impact other players in the space, such as Fluence, such as STEM? So you can see right here that Tesla continues to perform very comfortably by way of growth. This is something that we're seeing another essentially 50% growth in the space. And you can see that they're continuing to increase quarter over quarter as well as year over year. What I'm primarily going to be looking at is future correlation to the potential output from their factory that they're making in California to the actual growth and implementation. So one of the things that I want to look at when we're targeting these numbers is what does this mean for their actual growth? So if they're able to make their own battery packs, I would expect that to first off see margins continue to rise quite comfortably. However, we're currently not seeing that in terms of their actual statement of operations that you see here. So the company itself, in terms of energy generation and storage, continues to perform comfortably, now more than $1 billion per quarter for the second consecutive quarter. So you can see that revenues went from 1.1 billion to 1.3 billion. And so that growth looks very strong. Keep in mind, we don't have a lot of additional viewership or insight into what all this entails. For example, they do have their Tesla Auto Bidder, which allegedly is similar to STEM's Athena platform. If you look at their website, it looks very, very similar. However, Tesla tends not to talk about it on a lot of their calls, and it's not even mentioned in their earnings report. So I don't know if that revenue is in energy generation and storage, or if it ties into services and other. However, without that insight, we can still target energy and storage, seeing a $1.3 billion revenue stream, and that's on a quarterly basis. If we compare that to a company like STEM is still going to be about a third of that for their full year revenues, with more insight coming there over the course of the next few weeks when they announce earnings in February. However, the other side of this is the cost, where we can see energy generation and storage once again, and you can see that that cost continues to go up. So in the entirety of the past 4 quarters, we continue to see energy storage continues to be at or slightly below the cost of the actual revenue. So that means with fixed cost aside, again, this is strictly just the gross cost here, they're actually slightly profitable. So the question is, what is the actual profitability tied directly to this line of business, and what are they going to do on a go-forward basis? So let's scroll back up to their actual deployment. So here I am showing their operational summary. This is, again, their deployment of storage capacity. So you can see that right now they're showcasing about 6.5 megawatts, or 6,500 megawatts. That's about 6.5 gigawatts. To put that in perspective, in the Q3 earnings reported by STEM, they were at about 2.4 gigawatts. So once again, about a third of what you're seeing here. They're also energy contingent, being what you would expect to see, or the strength in the solar deployed. Once again, a significantly smaller number. So this is obviously an area where we continue to see Tesla continue to invest in, albeit they are doing so, if we bring in fixed costs, probably not at a level that is profitable at this point in time. This is a much larger company than STEM. So the question is, are they going to continue to invest resources into capacity? And it looks like by building a factory in California, they're going to have the capability to do so. So if they begin by producing more batteries, does that mean that they are going to continue to sell to competitors like STEM in this space? I believe that they would continue to do so because of the total addressable market, or TAM, in the space. I imagine that neither one of them is really worried about the capability to continue to grow at these levels. The question is, STEM is currently trading at a significantly smaller valuation, and there's been a lot of hype around the potential valuation that this line of business could add to Tesla, and a lot of people are saying that Wall Street is missing this. What I would highlight is this continues to be an area where some of the more established players such as Fluence and such as STEM continue to struggle to be profitable on a net margin basis, despite the fact that their gross margins continue to grow. It appears that Tesla continues to be in a similar capacity at this level. The question is, when they surpass that and they are able to be net income positive associated with this line of business, is what that could mean for earnings and accompanying valuation. It's something that I'll continue to watch from a Tesla perspective, and definitely something that I want to see how it impacts things like STEM and or Fluence. So if you found this content helpful, or if you'd like to provide some additional insight, let me know in the comment section down below or in the free to join Discord linked in the description. Thanks for watching. Talk to you later.